Hi all, just had a question posted in the classroom about under and over provisions. And you'll see, if you look at my material, I've got under and over provisions both under my current and under my deferred components of income tax. The under current, it's fairly obvious how it comes about. The question has been asked, how do you get unders and overs as far as deferred is concerned? So let me have a look at a quick little example on how that could happen. You'll appreciate that in any given year, so let's say we're doing 2018 is your current year, and you will appreciate then in 2017 one would have estimated the taxable income for the previous year. Right now, let's assume in that previous year they did a tax computation, and that tax computation yielded a tax loss of 10,000. All right. We then would have carried that loss forward to the next year, and that you'll understand is going to be debit DT SFP using a tax rate of 28%, and we would have credited our tax expense in profit or loss 2,800. All right, so we created a deferred tax asset last year on an estimated assessed loss. Now, in the current year, if we get our assessment from SARS and that assessment reflects taxable income of $1,000, then we need a SARS liability of 280. So you'll appreciate we had a SARS liability last year of 0 because we calculated a loss. So for your under over provision this year, you've got two entries you need to process. Number one is you need to credit SARS 280 and debit your current tax expense 280. And then in addition to that, what you need to do is you need to reverse out this deferred tax asset that you provided for last year, debit tax expense profit or loss, credit deferred tax, and you can see it there, 28, that's 2,800, 2,800. So what we've got then is an under provision, and you're going to see the under provision of 280 under current, under the component current, and you're going to see under provision 2,800, and that's going to be under deferred. Okay, so I hope that clears up how it is that we can have both a current and deferred under provision. The same would apply to over provisions. It could just as easily happen that we calculated taxable income in a prior year, so we provided for current tax expense in that prior year, and then you get the tax assessment this year, it reflects a tax loss. Okay, so what we're going to have to do is reverse out the current tax of the prior year, but do it in the current year, because it's a change in estimate, and then we're going to have to provide for that assessed loss we should have had last year in the current year, and that's going to be a debit DT SFP credit tax expense. Okay, so I hope you found that helpful, and I hope that answers a few of the queries that were asked in this regard.